This podcast is intended for investment professionals only. All investing involves risk.
Hello, and welcome to Elgin Talks. My name is Andrew Lowry, and I'm a content manager here at Elgin. And this week we're going to talk about the outlook for the rest of the year in private markets. I'm joined by two members of our private markets research team, Research Director Rob Marden and our Infrastructure Strategist Marija Simpraga. Rob, Marija, thank you very much for joining us.
Hi, Andrew.
I know we're at the midpoint of the year. It's kind of a natural time to take stock. What do we know now about private markets that we didn't know in January?
Yeah, so why don't I kick off there, Andrew? There were two things that we said would be really important this year. One being the interest rate cycle, and the other being the political cycle. And I think on those very basic things, we saw that pretty much right. The rate cycle continues to be one of the biggest drivers of market sentiment and where we see relative value. I think there's still some quite big questions out there, actually. Headline inflation has started to come down, but core inflation in the US, in Europe, and in the UK still remains quite high. So I think there's still some quite big questions about interest rates and the pace at which they're going to fall that we still don't know the answers to. I think on the political cycle, again, we've seen some things we knew were going to happen, but equally some things that have really surprised us. So in the UK, we've seen an election come much earlier than we thought. We've seen a Labour government with a very big majority, but off the back of the lowest proportion of eligible voters since the introduction of universal suffrage. So I think there's a really interesting question there about the longer-term prognosis for the UK. In France, we definitely weren't expecting an election this year, and that's been surprise on surprise. The election itself, then the potential for the National Front or the National Rally to do very well, but then actually quite a resounding success for what you might call the centre and the left. In the EU, we've seen something similar. Actually, we said the EU election was one to watch. There, we've seen quite a big increase in support for what you would call the sort of the moderately far right, and that I think has had a big implication there. Then in the Indian election, everyone thought Modi would have a very big success. Actually, that looks like he's moving into a coalition. So we've seen some quite big surprises on the electoral front, and we still have the elephant in the room, the US election. There we've seen, frankly, one of the candidates be convicted of a felony for the first time ever in history, and the other one in a battle to save their candidacy. So I think what that tells you is that politics is going to remain one of the signal things we're going to be talking about for the remainder of this year.
In your introduction to your mid-year outlook, you talk about how there's a lot of dry powder out there, that uninvested capital is at the highest level on record. Why do you think that is, and what needs to happen to unlock it?
There's probably two things to say there. Capital is still being allocated. That's one thing that I'll come back to in a second. But the rate of deployment has slowed down a lot. So we've got more water coming into the bath, but the tap that's sort of spending that allocation has slowed right down. On the fundraising side, we did definitely see the amount of money being allocated to real estate and infrastructure in particular slow down a lot in 2023, but still continued allocations to private equity in particular, which frankly surprised us to some extent, but to a large extent reflected the fact that many investors did not want to miss out on a vintage that they think might be quite interesting in terms of being contracyclical and capitalizing on weaker pricing. So that kept money flowing into the private asset classes, but the deployment side has hugely slowed down. And there's two really big drivers there. One is what we've already talked about, interest rate uncertainty. There is uncertainty over the appropriate target return to demand of investments now. And equally, for a lot of strategies that use leverage, understanding what the cost of that leverage is going to be, still many managers are sort of scratching their heads over that one. So that has definitely acted to bear down on the amount of deal activity. And the other side of it is what people euphemistically refer to as the bid-offer spread. But very fundamentally, buyers have not been willing to pay the prices that sellers want. And so deal activity has slowed way down. And we've not really, outside of a relatively few specific areas of the global private markets, we have not seen many sellers be forced to come to the market. So that has really slowed down on transactional values. What needs to change for that to really sort of start to turn around? We do need more confidence over the pace of interest rate cuts. I think that will certainly help. The other side of it is corrections in valuations, and those are coming through, although certainly the more that comes through, that starts to close that bid-offer spread. But I would say one of the other things that is one of our real sort of overarching messages is the need for discipline. In that scenario where you've got a lot of money building up and a shortage of deals to do, it's really tempting to make over-optimistic assumptions, to believe in things that maybe have a chance of success but not a high chance of success. This is an environment in which discipline really will count for a lot in terms of deploying but then delivering investment performance.
Marija, if we can turn to you, we've spoken on this podcast before about the megatrends that you guys see as driving performance in the medium to long term. Can you talk us through how your views on them have evolved over the course of the year?
Sure, happy to. So over the past sort of 6 to 12 months, we've really seen the AI narrative take center stage. And there's sort of the dominant narrative and there's a sort of a slight counter narrative which are kind of coming through. The dominant narrative is, of course, around the tremendous potential for economic growth, productivity gains that can come out of the sort of AI revolution. There is a kind of less vocal narrative coming through more recently about the amount of growth that's sort of priced into the digital infrastructure theme as a whole. And these are valid questions to ask, of course. But if you look at the fundamentals, it is really difficult to argue with the premise that the demand for digital infrastructure assets off the back of AI is only going one way, and that's up. So the projected rise in AI is just one of the key drivers behind the rapid growth in digital infrastructure. And just to be clear, when I say digital infrastructure, there's sort of an umbrella term for several different things: data centers, fiber networks, mobile towers, and various other smaller parts of the sort of digital connectivity market is what I mean. So outside of AI, data sovereignty and increased data consumption in general are also a strong growth driver for the industry. Now, data sovereignty is probably something that listeners will be less familiar with. This is the idea around the onshoring of data. Particularly in the EU, there are growing concerns about the privacy and safety of sensitive data. And those concerns mean that increasingly the data will have to be brought back, stored and processed in the EU, creating additional demand for assets that can support that. And so this is sort of a manifestation of another trend we've been talking about for the last 6 to 12 months, which is deglobalization. This is a broad term to reflect the trend towards governments opting to onshore at least some of the sort of critical supply chains and manufacturing. So I touched on data sovereignty, which is how we see the deglobalization playing out in the digital infrastructure world. In clean energy, there has been a pronounced push, especially in the US and slightly lesser extent in the EU, to onshore some of this critical clean energy supply chain and manufacturing. In parallel, we are also seeing more sort of local content requirements, trade barriers also coming into the picture and kind of affecting the renewable energy build out. So local content requirements, tariffs, other trade barriers do increasingly weigh on the mind of infrastructure investors in the sense that they can add to the cost pressures in this industry and can certainly affect project economics.
If we can turn back to you, Rob, in real estate, the conventional wisdom is that post-COVID, commercial real estate valuations are way down. But now I think we're leaving the immediate post-COVID period. Does the data bear that out? Are those trends going to continue, do you think?
Yeah, I mean, one of the real sort of, I guess, very tangible things, because most people have been in an office, either work in an office or have been to one, that sort of the impact of COVID on the office sector has really grabbed an awful lot of attention. That story is a little bit overblown. I mean, Marija and I have just come from our office to come and record this podcast. So clearly there is still a role for the office. It is by no means dead, but there's no doubt it is a challenged sector. The occupation levels in offices in most parts of the world are still lower than they were pre-COVID. The other thing that is, if anything, as important or maybe even more important is some of the capital expenditure requirements to refit offices for a net zero aligned world. Offices consume a lot of energy, and there's a lot of cost involved in taking them towards higher environmental standards. And that is definitely creating some quite big challenges around office investment performance. But it's really important to say offices are actually quite a modest share of most investment portfolios in commercial real estate these days. Maybe 20-30% would be a sort of a benchmark type of figure. It's actually residential and industrial that make up a much bigger share of investor portfolios, and globally probably between 2/3 and 70%. And the fundamentals there are much, much better. Relatively low levels of vacancy, which means high levels of occupancy, so good and consistent levels of cash flow. So I think it's really important to look at some of the detail within commercial real estate. The other thing I would say is to make a comment about geography. And one of the things we've seen, I mean, we as Legal in General are especially focused on the UK, but we do also have portfolios in the US, and we also have exposure to European real estate. And one of the things that we know is that valuations in the UK have been marked down particularly sharply. And for us, given that the UK is a large and liquid market, provided that you're looking at property types with good fundamentals, we think it's really quite an interesting time to be looking at the UK.
With uncertainty around interest rates continuing, how can we chart a path forward in real estate?
One of the things we're talking about it now, we've been talking about it for several years, is this combination of short-term resilience and long-term underlying fundamentals. And I think that's really key for real estate. It's very simple, but it's still profound. We think fundamentally about supply and demand. And we're looking for sectors with a fundamentally good balance of supply and demand, because that underpins rents and that underpins investment returns. So if we take it to maybe some of the D's that we've talked about, one is demographics, and that's obviously got a really clear link through to residential real estate. And one of the things that we're very struck by is the strong resilience and continuing investment performance of residential. And that can be residential of different kinds. So one of the things that is, a rapidly expanding part of the investment universe in the UK is what we call BTR, build to rent residential. In the US, it's generally called multifamily, but it's fundamentally the same thing. It's flats, purpose-built for rent. And that's a sector that's continuing to perform really well, and we think there's a lot more growth in that market. But it is also wider than that. You will also hear increasingly people talk about single-family housing, so houses, but also affordable housing, and that comes in different flavors. Some of it is affordable with a small I, so discount market rent. Some of it is also what you would call more pure social housing. So the message there is that there is still an awful lot of growth in that market, and it is different kinds of residential as well. The other thing that I would point to, particularly around this sort of the theme of long-term trends, would be around deglobalization, would be how that plays into demand for industrial real estate. And industrial is a little bit of a misnomer, actually, because some of it we are talking about manufacturing, and I'll say something about that in a second. But a lot of industrial property is actually storage and distribution. And in a world of deglobalizing supply chains, the need to be able to store and have resilience in supply chains is definitely boosting demand for industrial property. But the other aspect here, and Marija talked about this a little bit as well, in terms of ensuring continuity of supply and access to strategic manufacturing capacity, we are now seeing relocation of manufacturing capacity. I think that's going to be really important when it comes to clean energy. I think it's also important for some other sectors like pharmaceuticals. So both of those things together are definitely driving demand for industrial, and is one of the reasons why we continue to be really positive on that market.
Marija, your specialty is infrastructure, so let's touch on that for a moment. 2023, as it was for many investors, was a tough year for infrastructure investors. How's the first half of 2024 played out?
Sure. So yes, as you say, in 2023, particularly in the first half, transaction volumes dropped sharply, fundraising dropped sharply. And this again goes to some of the things that Rob's touched on. So there has been a question around the returns and what kind of risk premium you're getting for what are ultimately complex and illiquid assets. And there's been also the question around the bid-ask spread. So in order for transactions to happen, the seller and the buyer have to agree on price. And I think, frankly, that's been a challenge in the first half of that year, in any case. I think we started seeing that unwind a little bit in the latter half of 2023. And I think now we're seeing in 2024, we're seeing some tentative signs of recovery in fundraising and recovery in transaction volumes. So particularly in areas where we have better data, such as clean energy, we're seeing more deals coming through, and we're certainly seeing the competition for these assets intensify once more. We saw repricing of assets, particularly renewables, we saw repricing of assets take place in 2023. And I think that's kind of fed through to transaction volumes picking up. That's not to say that we're the challenges are over, and it's going to be smooth sailing. I think there's a lot of uncertainty around rates, which is one of the key drivers for this industry. This is long duration assets. We've all seen how valuations have played out off the back of the uncertainty, interest rate uncertainty. So rates again are a key consideration, and of course politics. So we have seen a lot of investment flow into renewables in the US, largely off the back of, or in great deal off the back of, the IRA legislation. And of course, with the prospect of a second Trump administration on the cards, I think the outlook for that remains quite uncertain. So some tentative signs of recovery, but a lot of uncertainty still ahead is the broad picture.
Now, we've touched on both these trends already, but I think they're worth really digging into. How can investors best align with both the carbon transition and the trend towards greater AI investment?
Sure. So the natural area where these two trends sort of converge are in grids and renewable investments again. So the rise in data center demand is unquestionable at this point, and the key bottlenecks in deployment will be around availability of clean power and grid capacity. For example, in Europe, data center power consumption is set to increase fivefold over the next decade. Right now, data centers account for only about 1% of the region's power demand, whereas the expectation is that this will grow to about 4% over the next decade. So these percentages seem small, but they're very small percentages of a very large number. So this works out into additional renewable capacity requirement of about 50 gigawatts, which is larger than the entire peak load demand of the United Kingdom. So it's a huge amount of additional demand just off the back of data center growth. And data centers will be in competition with other industries who are also looking to attract renewable investments, and there will be also concentrating demand in quite densely populated areas where land availability and prices can also be a constraint in addition to the grids. Usually, the grids are less well-discussed part of this narrative. So for every $1 spent on new renewable capacity, you need about the same amount or more to be spent on upgrading the power grids so that they can absorb this new source of power. So this nexus between grids, renewables, and data centers will be the linchpin around the future economic growth. And for investors, this means that these are the areas where we'll see the most growth and investment opportunities will rise accordingly. But it also means that investors can't think of these assets in silos anymore. So thinking about the synergies and connection between them in a portfolio setting will be the key to increasing allocations in a sustainable and efficient way.
It's really putting the mega into megatrends there. Rob, private credit is another asset class that gets a lot of attention. Do we see it continuing to provide a premium over public credit?
Yeah, I mean, whenever we have a conversation about private credit, I think it's quite important to recognize that we're talking about quite a diverse space, and there's lots of different dimensions to describe that. But in particular, it is really important to think about investment grade private credit and sub-investment grade. And it's that investment grade space, and using the rating agency terminology, that's with a credit rating of at least BBB. That's where the comparison to public credit is most obvious. When we're doing transactions in that space, and we do a lot, we are always testing the value against the public markets, and we're still seeing good levels of premia for illiquidity and for complexity. We're still seeing good levels of market discipline. Sub-investment grade is more of an absolute return strategy. It gives higher levels of return, but it does come with greater credit risk. The absolute return levels are still strong there, but one of the things that we are noticing is that bank lending has actually started to loosen up this year. And if anything, that's creating a little bit more supply in terms of credit. And so we are seeing a little bit of pressure in terms of credit spread. So a slightly softer risk premium. Still healthy, but a little bit softer than it was. So I think really important to think about investment grade and sub-investment grade a little bit differently.
It's the usual investor essay question for private credit. What are the risks? What are the opportunities going forward?
Well, in credit, the fundamental risk is always about default. Now, in investment grade, we fundamentally do not see defaults, but we still don't see defaults. And one of the things that we've been very conscious of as investors, allocating to that space is about making sure that our underwriting is as disciplined as it ever has been to maintain that very, very low default risk. Even in sub-investment grade, actually defaults have been very, very well behaved so far. They've ticked up a little bit, but they still in absolute terms, remain really, really low. But I think if there is a risk, it is with this extended rate cycle that we might start to see more pressure on borrowers, might start to see rising levels of distress. So I think the really key aspect here is about quality of credit underwriting, staying close to borrowers so that you can identify warning signs early. That's on I guess the risk side. The opportunity side actually comes back to some of the things that Marija was talking about a minute ago. We think there is a really interesting set of angles around transition alignment in credit. So lots of the opportunities that you would see on the equity side in terms of funding decarbonisation, in terms of funding digital, will have credit requirements that sit alongside them. So we think there's a really interesting space in transition-aligned credit that's going to increasingly emerge over the next 18 to 24 months. So that's probably what I would be picking as a key opportunity.
Now, we're recording this in mid-July and we're all starting to think about the summer holidays. I'd love to hear about what beach reads you guys have in store for this year.
So I read on a friend's recommendation the novels off of which the Netflix series Three-Body Problem is based by author called Cixin Liu, if I'm pronouncing that correctly. And it is, I found them really interesting thriller-like reads I couldn't put down. And at the same time, I learned about quantum physics and astronomy and things like that. Granted, I started off from an extremely low base, but I still feel like I had some fun and I learned something. So I think that's a good kind of mix to take to the beach with you.
Rob?
Oh, mine are way less highbrow than Maria's. So I am going to be on the beach next week. One is one that I have read. One is one that I'm going to read. So one, this was recommended to me, and I think this is just a gift to anyone. There is a book called 4,000 Weeks by Oliver Burkeman, which I would call it the anti-productivity book. So I think that's a great thing to read. The other one is I've had this on the shelf for a while. This is The Storyteller by Dave Grohl of the Foo Fighters. It's meant to be brilliant. He's a lovely man, so I'm gonna finally get to reading that.
Fantastic stuff. You can read this year's mid-year private markets outlook from Rob, Maria and the rest of the team at elgin.com/realassets/insights. Guys, thank you very much.
Thanks, Andrew.
Thanks, Andrew.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal and General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal and General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal and General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.